Chapter 15, Breaking Down Key Statistics. Key statistics are vital when you look at long-term profitability and potential company performance. These statistics simplify important long-term factors in a few simple numbers. You can use key statistics to help you decide whether you might still like a stock in a decade or so. When you look at a stock on Yahoo Finance, you will see these statistics formatted like the photo below. On other sites, the format of these statistics may look different, but the important statistics still mean the same thing. Here are the key statistics for International Business Machines Corporation, IBM. We see the previous close at 145.32, the open at 145.53, the bid at 144.01 by 900, the ask by 144.53 by 800, the days range from 144.73 to 145.94, the 52-week range from 137.45 to 171 to 13, the volume at around 3.093 million, and the average volume at around 4.225 million. Market caps around $132 billion, beta around 1.04, PE 23.32, the earnings per share, the current quarter TTM is 6.21. Earnings date is October 16th, 2018. The forward dividend yield is $6.28 a share, or 4.28%. And the ex-dividend date is the 9th day of the 8th month in 2018. And the one-year target's $165.11. First thing you'll see is the previous close price. The last transaction for the market day prior occurred at this price. This is what daily price and percent change for the day is based on. Next, you'll see the stock's open price for the day. The difference between this price and the previous close is your pre-market change. Big differences between previous close prices and open prices draw a lot of attention to a stock. As we talked about earlier, this attention is great for 9 to noon trading because it significantly increases early morning volatility. Besides acting as an early indicator for huge potential movements, a large difference between the previous close and open price can indicate very high days where the price may go up exponentially before dropping off in a sell-off. For long-term investors and medium-term trades, this can provide a great time for you to sell part of your position and lock in some gains to reinvest in another stock. For active traders trading the right stocks, this presents you with opportunities for massive gains. We will talk more about trading pre-market gainers in Chapter 36. For stocks that open significantly lower than they previously closed, say over 5%, the attention they get is a little different from gainers. Whereas gainers attract brand new buyers, losers attract sellers. However, where these are different sellers, they are usually existing shareholders liquidating a position out of fear, uncertainty, doubt, changing company mentality, etc. For this reason, losing stocks typically do not attract as much volume or volatility as gaining stocks. This makes actively traded losing stocks a fairly difficult venture because prices usually stay relatively flat when volatility decreases, charts simply trending sideways. However, losing stocks present terrific buying opportunities for you to enter long-term and medium-term positions, buying up cheap shares midday. Our next key statistics are the bid and the ask. These two statistics represent a very important part of active trading. Level 2. Level 2 shows all the limit buy and limit sell orders that are not filled at market price. We will talk more about different order types in Chapter 19, but the important thing to know is that these orders are set for a specific price. In the Level 2, you see all the bidders willing to pay a price for a stock and all the askers willing to sell a stock at a price. The Level 2 makes a list of all open orders and sorts bids in ascending order and asks in descending order. This means that the highest bid and lowest ask show up on the top of the Level 2. These two numbers are the highest paying unfilled buy orders and lowest priced unfilled sell orders are what Yahoo Finance puts in front of the X in their bid and ask numbers. When you submit an order at a specific price that does not immediately get filled, you can instantly see your order and the number of shares added into the level 2. You can also see unfilled orders in the order book. The order book records all unfilled orders and can be put on a graph to show the depth of a market. You can constantly see a stock's level 2 change as new bidders and askers put in orders, bidders and askers get filled, and general price movement in any direction occurs. The same is true for the order book's market depth chart. Here's a rough example of an order book's market depth chart. The more shares in this chart at different price levels, the more liquid a market is. Liquidity, how easily you can enter or exit a trade, is extremely important if you trade actively, because the last thing you want to do is be forced to sell at lower prices due to low market liquidity. Then we have a picture. It shows the order book. On the left side shows the number of shares, and on the bottom we have the bids on the left and the asks on the right. So it starts from $64 and ranges, goes up to $69. This is an example stock. We see at the ends of 64, 69, we have a lot of people trying to buy and a lot of people trying to sell. And as we get closer towards what would be kind of the actual price, $66, $67, there's less buyers, less sellers, until you get to the middle, where there's a very, very small amount of buyers and sellers, because when they meet, a transaction goes through, the order gets filled, and it's taken out of the order book. There are fewer orders between buyers and sellers where the prices meet, because this is so close to the last transaction price, the price that is displayed for stock. When you approach this price as a buyer or seller, there's a good chance your order will be filled in a liquid market, and your order will disappear from the order book, entering the transaction history. Yahoo Finance does not show you the full level 2 or order book for stocks, but rather they display an often delayed national best bid and offer. You can find these essential tools through your broker's trading platform, which should also have significantly improved data feeds. Whenever you submit an order, you have to decide how many shares to buy. Next to the X in Yahoo Finance's bid and ask boxes, you can see the number of shares currently available to top bid and bottom ask price level. The number of shares next to the bid and ask represents the total number of shares that all buyers or sellers are willing to buy or sell at the bid and ask. For IBM, this means that 800 shares from an unknown number of people are for sale at $144.53 a share. This is the only shown on the highest bid and the lowest ask on Yahoo Finance, but your broker should share amount information for all price levels on the level 2, which you can use to find specific buyers and sellers of a stock you're trading. For active traders, you can look at the volume of sellers or buyers at certain levels in the level 2 to find price levels that a stock may have a difficult time passing because of the number of buyers or sellers at that price level. These levels are often called buy and sell walls in the market depth chart. The difference between the highest bid and the lowest ask is the spread. Generally, spreads decrease as volume increases. Be very careful trading extremely cheap stocks with very large spreads, because you may enter a position and find that your only way out is to sell your shares at a much lower price than you acquired them for, because the bid is significantly lower than the ask. Also, watch out for suspicious characters who promote cheap stocks with large spreads, because they may buy shares on the significantly lower bid and sell them to you at a much higher ask. Especially in low liquidity scenarios, you should avoid wide spreads to mitigate risk. Spreads matter less for long-term investors and medium-term traders. For IBM, the current spread is 52 cents, a fairly large spread for such a large stock. IBM's spread here is most likely very large because our snippet was taken during pre-market hours with lower liquidity. For most large and active stocks, expect to see a spread of around 1 to 2 cents. Keep in mind that some more expensive stocks may have larger spreads because of the relative importance of 20 cents for an $800 stock, which is much lower than that for a 25-cent stock. For all types of trading, you should aim to buy the bid and sell the ask. We will talk more about specific types of orders in Chapter 19, but just remember that you can set your price for whatever you buy and sell. All traders can save themselves a little extra money by buying the lower bid and selling the higher ask. Playing the spreads to your advantage is especially important for active traders. By getting the best possible entries and exits, you'll be able to maximize your trading profits. Here's a refresher image of IBM's key statistics. After the bid and ask, we see the days range and the 52-week yearly range. These two ranges are also easily determined by looking at a stock's chart. Sometimes there is a slider here that visually shows where the current price is on the range. Look at the days range midday through the day can be a great way to predict whether a stock has hit a bottom or a top for the day yet. If you're looking at buying for swing trading or long-term entry, you can try to get in on a day when the price is at the bottom of the daily range instead of new highs. For active trading, you will usually see new highs and judge the daily range exclusively on charts. When stocks get tons of attention, volume, and media coverage while close to their 52-week highs, ask yourself if you think the stock has the potential to set new highs and grow its 52-week range upward. Apply a similar mentality to stocks near the bottom of their 52-week range. Price ranges reflect chartable price movements and not much more. Ask yourself what could cause a stock to fall down from after it hits a high 52-week maximum if it falls towards the middle or bottom of its 52-week range. Is something bad happen this year? Is the company having an internal problem? Did the marketplace demand this company? Can the company easily access all required goods? Did the company recently downsize? What do the annual report's forward-looking statements think? Are there suddenly active competitors in this space? The next key statistics are daily volume and 3-month average volume. In the case of IBM, the average daily number of shares bought and sold for the past 3 months is 4,225,556. High daily volumes tell you that there's a lot of interest in a stock because there are a lot of people trading it. Volume is always good in the market because it tightens spreads and is the primary factor behind liquidity. Your trades will fill quickly in high volume markets at your desired price. You do not have to worry about volume too much for your long-term investments. If you hold a position for a decade, you'll be happy to eventually sell it if you have to wait an extra 60 seconds or so to be filled. However, you should always keep volume in mind when you actively trade. First of all, you can expect more volatility in stocks that have significantly higher daily volume than their 3-month average, since an abnormal catalyst drew investors to a stock on a particular day. This increased volume indicates that more traders are buying and selling a stock than usual, increasing liquidity, volatility, etc. When trading 9 to noon, be especially skeptical about stocks with under 500,000 daily shares exchanged. Even extremely early in the trading day, most gaining stocks that are worth your time will easily pass this volume number. Keep in mind that small stocks you actively trade may have very small average volumes. This is fine as long as the news, pre-market gains, or other catalyst that drives people to pay attention to a stock increases the daily volume to highly liquid levels. When you trade stocks that have under around 500,000 to 1 million shares exchanged each day, you run the risk of failing to get your sell orders filled at market prices, leaving you stuck in a trade that should have been quick. You can spot low volume on stock to be careful with when actively trading when you see flat 1-minute candlesticks. Flat candles open and close with the same price because the market either exchanged no shares or only traded shares in the same open price. When you see a completely flat candle, question the liquidity and underlying volume of the stock you are investigating. Do not forget to look at volume bars on the bottom of your charts. Low liquidity volume frightens other traders away from a stock, thereby lowering its tradable volatility. You can use volume to gain an edge over others by watching out for abnormally large red volume bars. Usually, you can expect a stock to approach its minimums when there are significantly large red volume bars at the same time as a downward movement. These bars are red because there is a negative price change, but the relative magnitude of them is significantly important because it indicates that tons of people were trading to get out of their positions in a stock. artificially lowering the price to its minimum or close to it. Let's look at a real example of this trading principle with IBM around the time of the 2008 market crash. We see two large downtrends here in the mid-2005 and mid-2008. Those are shown in the chart above. Notice that there are significantly taller red volume bars around the time that the biggest downward movement happened at both of these drops. Buying when you see tall red volume bars proved extremely effective in both of these scenarios, especially in the long term, as shown in the above chart, as it continued to increase into 2012 and since then. Keep in mind that this principle holds true in active trading on a short-term basis as well. Here's a swing trading example with Titomic Limited, and then it shows a chart, and you can see a large red volume candle. TTD.AX bottomed after an ABCD movement almost exactly where the large red volume candle occurred, forecasting a reversal. We will explore ABCD setups in chapter 28. The next key statistic is market capitalization. IBM's market cap is $132,141,000,000 as of today. You get this number by multiplying the IBM price per share by the number of outstanding shares for International Business Machines Corporation. Market caps are essentially what a company is worth in the stock market unless it has a class of valued shares that are not traded publicly. Many companies issue shares like these under different classifications, such as Class B shares, in order to keep board of directors voting rights in the company. For example, a company's Class A stock could carry 1 vote per share, whereas the private Class B stock carries 10 votes per share. This would allow a company to control internal affairs without worrying about public shareholder voting response. In general, though, market capitalization is a fair way to estimate the value of a company. Once you know the value of a company, you can classify them into small cap, mid cap, and large cap companies. Generally, a larger market cap brings more attention, volume, and newfound investors to a stock as media attention compounds. Companies that prove they are worth a lot in the market with their large or medium capitalization are great candidates for your long-term investments. You will usually trade smaller market cap companies actively since they have increased volatility, often due to lower floats. We will discuss these terms and talk more about finding 9 to noon trades in chapters 23 and 36. A lot of trading is based on public perception of a company. Sometimes you may see a regular company valuation based on principles rather than fundamental share value. Remember to use your knowledge of news to experiment in publicly commentated positions, even if you disagree with some companies and their stocks. The government taxes capital gains from all companies equally despite their values and valuations. With quick and well-informed positions, you can take advantage of short-term investor trends. Just remember to set disciplined stop losses and understand the increased risk of trading media-influenced stocks. See chapter 19 for stop losses. In case you forgot, here's a refresher image of IBM's key statistics. Our next key statistics is beta. You can use beta to quickly estimate a stock's long-term volatility and performance. Yahoo Finance uses a single regression beta. Some find this beta calculation unreliable because its value can be manipulated by changing time periods or comparison indices. See chapter 16. To calculate beta, Yahoo Finance uses individual stock covariance compared to the S&P 500's 3-year return and the S&P 500's 3-year variance. You can calculate a stock's beta this way by using the formula beta equals covariance of a stock's 3-year return variable to the S&P 500's 3-year return divided by the variance of the S&P 500. This beta value represents a historical correlation between the stock and the S&P. Stocks with beta values greater than 1 have historically been more volatile than the S&P, whereas stocks with beta values less than 1 have historically been less volatile. For example, the stock with a beta value of 2 has historically gone up 8% for the S&P's every 4% increase. A stock with a beta value of 0.5 has historically gone down 5% when the S&P drops by 10%, and so on. Higher beta values indicate historically higher volatility and aggressiveness compared to the S&P's movement, and lower beta values indicate a more conservative, slower moving stock. Negative beta values indicate that a stock moves in the opposite direction of the S&P. Lower negative values indicate greater inverse volatility, as with normal betas. Lower being larger. Negatives. Stocks with low positive betas under 1 can be strong candidates for long-term investments because they are historically less risky. Medium betas, say between 1 and 2, also stand out as strong potential long-term picks for higher rewards. Ensure that your long-term portfolio balances between risky and safer stocks to take advantage of up markets and protect yourself in down markets. We will talk more about diversification in Chapter 35. Higher beta stocks should be analyzed for market factors that may increase volatility. 9 to noon stocks often have higher beta values and are very risky unless carefully and actively managed through technical analysis, coming in Part 2. Beta alone should not determine whether or not you like a stock. None of these key statistics should. However, when used together along with technical analysis and deeper corporate background research, you can use these tools to create strong, outperforming long-term portfolios. For medium-term and active trading, beta can be used to predict how much a stock will move in one day if the market only moves a certain percentage. For example, you might see daily resistances on a stock with a beta of 4 once its daily percent change reaches 4 times that of the S&P. This principle applies mostly to swing trading and can be used to find opportune times to exit a position held for more than one day. Our next key statistics are EPS, TTM, earnings per share for the trailing 12 months, and PE ratio, TTM, profit to earnings ratio for the trailing 12 months. Earnings per share is calculated by dividing a company's total earnings for the last 12 months by the number of outstanding shares. This shows how much profit the company has made per share of stock for the past 12 months. This number is just as important as earnings, the money a company brings in from revenue after expenses. When a stock's EPS is negative, you know that the trailing 12 months have had overall negative earnings. The company lost money. I'm sure you know that many companies lose money in some markets and make tons of money in others, but you should be careful when you see a company with a negative EPS, at least for long-term investing. It is usually a good idea to invest in companies that make money. For active trading, most of the companies you see will have negative EPS numbers. This is fine because you do not care if the company you trade goes bankrupt the day after you buy and sell its stock. You can also divide a stock's share price by its EPS to get the price to earnings ratio. The PE ratio is a terrific tool for analyzing a company's current valuation. Average PE ratios are around 20. Companies with PEs over 20 are valued more by the marketplace than their earnings alone, and companies with PEs under 20 are often called undervalued. When stocks have PEs that significantly exceed 20, ask yourself why the market values the stock so much. Similarly, ponder why a company may have an extremely low PE when you see one. Lower PEs are generally good, and EPS depends a lot on the number of outstanding shares. A PE ratio of 20 means that you pay $20 for every dollar a company makes to own their stock, since EPS times PE ratio equals share price. If you buy a company that has a PE of 8, it would take you 8 years to make your initial cash back if absolutely nothing changed with the net income of the company. Note that companies with negative earnings have no PE ratios. Earnings per share is reported on companies' quarterly and annual reports. Yahoo Finance calculates EPS and PE ratios using GAAP earnings, a number that comes from a company's reporting books and uses generally accepted accounting principles. GAAP earnings are useful for comparing one company's earnings directly to one another. You may see non-GAAP EPS reported in a company's report as well. These calculations generally account for specific expenses, amortization, income, taxes, and many other business-specific numbers they are unable to include in GAAP earnings. The market and its analysts will generally only look at GAAP earnings, but you should also look at non-GAAP earnings when investing long-term because these numbers are more representative of a business's true operations in income. Non-GAAP earnings can provide you with a more accurate and clear insight into a company's profitability, but you should stick to GAAP earnings when looking at PEs and comparing companies. To see more about a company's financials without directly reading these reports, click the Financials tab under a stock quote in Yahoo Finance and see the company's income statement, balance sheet, and cash flow. An income statement shows a company's revenue and expenses. You can use this statement to determine a company's net income. Balance sheets summarize the assets, liabilities, and equity in a company. You can subtract a company's total liabilities from a company's total assets to calculate the book value of a company. The value if they sold all their assets and paid all their liabilities. If the market cap is higher than the book value, then the market is going to pay more than the basic value of a company because they think its assets provide more value. If the market cap is lower than a company's book value, then the market is not willing to pay for the full basic value of a company because they do not see the value in the company. Investing in companies valued below their book value allows you to buy a part of a company at a discount to the book value. You can have terrific value entries using this method, but always ask yourself why the market does not want to pay full price for a company's stock. Additionally, ask yourself why the market is willing to pay extra for a stock when its market cap significantly exceeds its book price. When book prices and market cap are very similar, ask yourself why the market does not pay more for a company. Always stay skeptical. Try to find companies with a fair price compared to their book value and industry context. You want these companies to consistently increase their assets, book prices, and stock prices in the long term by growing their underlying businesses. For reference, here is a strong book value growth chart to watch for and imitate through your long-term portfolios. And then we see a chart with the S&P 500 book value per share, and it just kind of consistently goes up from 300 to 837 approximately from 2000 to late 2018. The last financial statement in Yahoo Finance summarizes for you under the financial tab is the company's cash flow. In addition to the income statement that shows you how much money a company is taking in, the cash flow statement clarifies where the money moves in the company. You can analyze where cash comes in and out of a corporation to understand how efficiently their professional operations and management function, among other things. To get a quick insight into a company's revenue and earnings, look to the bottom right of your stock quote on Yahoo Finance to find these two useful charts. The first chart we see is the financials chart, and that shows annual revenue and earnings in whatever billions, millions for the respective company, and you can look at trends over time in those. For IBM, it was pretty flat, trended down a little bit in 2015, and then we also see earnings for the last 4 quarters and projected earnings for the next quarter. So we see the actual earnings that came in and the estimate, which is what analysts thought it would be, an average analyst price target. So there that's when the company reports their quarterly reports and they beat it or they miss it. Stocks generally go up with satisfactory quarterly earnings beats and down after poor results. This is simply the stock's price adjusting to the actual underlying company value or public perception of that value. Lowered revenue, customer loss, or poor management can adversely affect share price even when a stock beats analysts' expected earnings per share. Either way, expect to see large price movements when earnings season rolls around. Guessing whether a company will beat earnings projections can be very difficult. If you have a solid grasp of the company's market, then you may be able to accurately predict an earnings outcome. However, most earnings predictions are 50-50 guesses, which makes large gambles on quarterly reports risky. I will say that one more time to make sure you remember it. Earnings reports are unpredictable. Unless you have exceptional knowledge about a company's market sector, learn to measure this volatility and even profit from its short-term market reactions. See Chapter 21. In case you forgot, here's a refresher of IBM's key statistics. Earnings dates simply state the next date that the company reports quarterly earnings. Earnings reports almost always come out right after market close. Next, you'll see forward dividend and yield. Dividends are terrific for your long-term portfolio because your stocks will pay you for holding them. On top of that, on top of your gains through appreciation, companies that pay dividends make you money by paying you in cash that you can then reinvest and compound back into more stock. IBM will pay an estimated $6.28 or 4.28% based on current price per share. The total dividend in the coming year. This means that you will be paid $6.28 in your brokerage account for every share of IBM stock per annum. IBM distributes its dividends in quarterly payments. Some companies may elect to make larger annual or semi-annual dividend payments, while others elect to pay monthly dividends. As long as you own a stock before the ex-dividend date that we see above and continue to hold it until payment date, the underlying company will pay you in the stock's next dividend distribution. Dividends, like everything else in the market, are not guaranteed. A company can choose to stop paying dividends at any time. However, you can minimize your risk and establish dividend income streams by investing in large companies that have a strong track record of paying dividends. Great companies will increase their dividend payments to investors over time as they continue to make more money and their stock price increases. Sometimes, companies might maintain consistent payment dividends on their stocks by increasing the cash value of their dividends because of recent gains in the stock price. This sort of behavior shows that a company cares about its shareholders and is a good investment. You can learn more about how a company treats its shareholders by looking at their dividend payout ratio. Yahoo Finance displays stocks' dividend payout ratios under the Statistics tab in the bottom right. Alternatively, you can calculate a stock's dividend payout ratio yourself by using the formula dividend annual dollar payout divided by earnings per share GAAP equals dividend payout ratio. Newer or smaller companies usually have lower dividend payout ratios so that they will have more money to reinvest into the company. Inversely, large and established companies usually have higher dividend payout ratios. IBM's dividend payout ratio is currently 97.28%, which means that they pay shareholders 97.28% of their net GAAP profits. Remember, the shareholders own stock, which is part of the company, and executives who deserve compensation for their hard work at a company usually receive tax-preferred payments in the forms of dividends through qualified dividends. Even if you immediately reinvest your dividend income, you will pay taxes on it as if it was ordinary income, paying ordinary federal income and state taxes. Qualified dividends, however, are taxed at long-term capital gains rates, which are based on income brackets and much lower than ordinary income taxes. For you to qualify for qualified dividends, according to the IRS, you must be paid by an American company that qualifies for qualified dividends, some foreign exceptions, and hold stock for over 60 days, 90 for preferred stock, out of the 121-day period, 181 for preferred stock, beginning 60 days before the ex-dividend date, 90 for preferred stock. Preferred stock is stock that guarantees you a fixed dividend paid before common stock. This kind of stock often carries no company voting rights. Whether or not a dividend is qualified determines your taxes that you will pay on it. In 2018, refer to the following tax chart, which looks at your adjusted gross income to determine your qualified dividend tax rate. And then in our chart, we have the qualified dividend tax rate on the left from 0 to 15 to 20%. And then we have our categories for single, married, filing jointly, or qualifying widower, head of household, and married filing separately. The qualified dividend tax rate, it ranges, as a quick example, for single individuals from 0 to just under $40,000 income, you're going to have 0% tax rate. From about 40 to 510,000, you're at 15, and then over that, you're at 20%. It just depends based on your situation, marriage-wise, return for your taxes, and it's just a number. So just look at the chart and figure out where you are, and you'll be good. Similar to long-term capital gains tax rates, you can actually avoid all taxes if your income bracket is low enough, showing that the government wants you to save and invest to grow your wealth through assets. However, Non-qualified dividends are included in your adjusted gross income and taxed at your marginal income tax rate. On top of this, high-income investors pay a 3.8% net investment income tax for any interest, income, capital gains, and other investment income that exceeds the following MAGI thresholds. We looked at modified adjusted gross income in Chapter 7, 2017 numbers. Tax filing status on the left, MAGI threshold on the right. We have single, 200 grand, married filing jointly, 250 grand, head of household, 200 grand, married filing separately, 125 grand. You generally do not need to remember these tables or worry about how your dividends are classified. Form 1099 Div and 1099 Int from your broker will clearly lay out your income information for you to simply insert into tax returns and provided calculations. You can check the dividend payment history, dividend payment amount increases, and dividend payment schedule for any common stock by opening and expanding its Yahoo Finance chart and hovering over the D icons at the bottom of the chart above the volume bars. Keep in mind that these will not show up for stocks that do not pay dividends. Stocks that do not pay dividends will show an NA for dividend yield and have no ex-dividend date. If a stock paid timely, increasing dividends every quarter for the past decade, then it will likely continue to pay timely, increasing dividends every quarter. Stocks that pay suspiciously high dividends should be investigated for signs of financial hardship. Very high dividends can be used to draw in unsuspecting investors. High-yielding dividend portfolios are great for down markets because underlying companies pay you even if the stock loses value. Moreover, you can take dividend payments out of your portfolio without selling any positions. Keep preferred shares in the back of your head. Preferred shares have dividends paid out before common shares, often trading slightly historical returns for higher dividend payments. Our last key statistic is the 1-year target estimate. This number is the average predicted price from all public analysts on Yahoo Finance for the next 365 days. You can assume that this number is based on speculation and poor predictions, but you should still pay some attention to it. Although nobody really knows where a stock could potentially be in a year, it is always good to see public analysts predicting that a stock's price will increase if you like said stock. With that said, do not worry too much about the statistic unless it is radically lower than or higher than the current price. If you see a target estimate that astounds you, ask yourself why analysts predict that price. Keep in mind that larger stocks have significantly more analysts than smaller stocks, so the average price estimate on larger stocks combines many more prices than estimates for smaller stocks. All of these key statistics act as terrific indicators of a company's overall health and future potential. However, these statistics should not be singled out and used alone to determine whether you want to invest in a stock. Use these statistics considerately for long-term positions and implement them into your larger stock analysis skill set.